Oil rigs just hit a 4.25-year low. U.S. rig count at 406, down 69 from last December. Yet production is still creeping upward, 13.84 million barrels per day. That shouldn't be possible until you see what's really happening offshore. In the next 3 minutes, you'll discover why oil's 22% price collapse doesn't tell the true story, how Deepwater technology just broke every assumption about production resilience, and why consolidation in gas, not oil, is the real power that's the move that's reshaping next year, 2026. I'm Mark Roach, petroleum engineer, 30 years in this business, FutureWise Energy, independent analysis. Here's what the market may just be missing. Baker Hughes reported 406 oil rigs this week. That's the fewest since 2021. Yet, U.S. crude output remains near an all-time record high. Why? How? Well, one word: efficiency. Longer laterals, smarter spacing, better completions. The Permian's doing 6.6 million barrels per day on 251 rigs, down 53 from a year ago. Here's what's actually happening and why it matters. U.S. rig counts are at a 4.25-year low. 406 oil rigs, down 69 from a year ago. Logically, fewer rigs should mean lower oil production. Well, the EIA's own forecast backs that up. They're projecting U.S. oil output will average 13.6 million barrels per day in 2025 and then decline by 100,000 barrels per day in 2026 to 13.5 million barrels per day. Well, that's the consensus view. Reasonable, data-driven. And it may be right, but there's a counter-narrative worth watching. Efficiency gains are outrunning the math. A well drilled today looks nothing like one from 2015. Lateral lengths have extended from 7,000 feet to 15,000 feet. That's just in the leading edge plays, but that's so dramatic, 7,000 feet to 15,000 feet. Now, completion designs, they are now using proppants that cost $20 per ton of proppant instead of $500 to $1,000 per ton of proppant. ExxonMobil's already running that playbook, petroleum coke instead of ceramic, and that's adding 42,000 barrels of incremental output. The Permian is the perfect example. It's down 53 rigs year over year, yet production's tracking towards 6.6 million barrels per day in December. That's nearly 50% of all U.S. oil output. Is it sustainable? Well, the EIA says no. Production will decline starting in 2026, next year. Permian operators might say, not yet. The basin's approaching peak. But technology and operational discipline are stretching that timeline. The law of diminishing returns, well, it's real, but we're not there yet. For the market, production resilience is real, even if it's unsustainable. And that matters for price expectations over the next 12 to 24 months. Now, here's where things really get interesting. While everyone's watching the Permian rig count, something bigger is happening. 5,000 feet underwater in the Gulf of Mexico, Chevron and Total Energies are deploying 20,000 PSI blowout preventers. That's ultra-high pressure technology that can withstand pressures that would not have been possible 5 years ago. The Anchor project is proving it works. Peak production is 75,000 barrels per day, 30-year productive life. And get this, it adds roughly 5 billion barrels to recoverable reserves in the Gulf alone. Now, the EIA's forecasting the Gulf of Mexico crude output rises from 1.8 million barrels per day today to 2.4 million barrels per day by 2027. That's 600,000 barrels of new supply, 600,000 barrels per day of new supply from fewer rigs, from deeper water. But it doesn't stop at the US Gulf. Global deepwater production is expected to grow 60% by 2030. Ultra deep water, that's depths over 5,000 feet. That will account for half of all deep water by the decade's end. Total deep water output hits about 17 million barrels of oil equivalent by 2030. That's up from 10.4 million in 2022. So going from 10.4 million in 2022 to 17 million barrels of oil equivalent per day in 2030. What does that mean? Well, it means geopolitical disruptions matter less. This is very significant. Geopolitical disruptions matter less. It means spare capacity becomes irrelevant, and it means OPEC's production discipline, their entire strategy, becomes a rearguard action against inevitable supply growth that they can't control. Now, oil M&A is dead. It's down 33%. Oil companies can't agree on valuations when crude's at $57.84 and trending lower. But watch natural gas. Watch it carefully. Gas consolidation hit $30 billion in the first 9 months of 2025. That's already exceeding all of last year's $22.5 billion. JERA, Japan's biggest power generation company, just paid $1.5 billion for Haynesville Basin production. That's 500 million cubic feet per day for a 10-year contract to supply LNG overseas. SM Energy and Civitas Resources just announced a $12.8 billion all-stock merger. 823,000 net acres, $1.4 billion in projected free cash flow, up to $300 million in annual cost synergies. Well, the deal matters because it's mid-caps consolidating without operational overlap. They're buying scale for scale's sake. Here's why. LNG export demand is structural. The U.S. hit 20 BCF per day of LNG feed gas consumption for the first time in history, November 9th, 2025. The EIA is projecting 14.9 BCF in 2025, 16.3 BCF a day in 2026. That's 25% year-over-year growth. And Russia's pivoting hard east. Gazprom's shipping 38.6 to 38.7 BCM per billion cubic meters per year to China via Power of Serbia. That exceeds design capacity. Russian LNG flows to China doubled to 1.6 metric tons in November alone, making China's second largest LNG supplier after Qatar. The consolidation wave in gas isn't about efficiency. It's about positioning for a fundamental reshuffled global trade. Europe's out, Asia's in. And American producers need enough scale to compete against JERA, Shell, Equinor, and state-owned enterprises that measure returns over decades, not quarters. After BP just had its best exploration year since Johan Sverdrup in 2010, 3 major discoveries in the North Sea. Omega Alpha alone, 96 to 134 million BOE. That's not a rounding error. That's a new field. Cyprus, Kuwait, Suriname, all showing commercial potential. The idea that exploration is dead, well, really, that may be wrong. The idea that deep water's done, well, that's certainly wrong. The idea that the next decade's oil supply comes from efficiency alone, absolutely wrong. So oil's down 22% from a year ago. Rigs are at a multi-year low. OPEC's hit pause. The headlines say collapse. But that's not the story. The story is technology, deepwater, automation, completions. It's outrunning depletion. The story is consolidation in gas, and it signals a permanent realignment of global energy trade. The story is mid-cap producers are positioning for a decade where strategic geographic advantage matters more than absolute scale. The oil glut will come. Prices will stay lower longer than you expect, but the industry that emerges on the other side won't be the industry we knew. It'll be deeper, more efficient, more geographically fragmented. And if you're not prepared for that transition, you'll miss the signal until it's too late. Stay focused on the fundamentals, not the headline volatility. I'm Mark Roach. This is FutureWise Energy.